Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Abhishek Ranjan. Joining me on the show today is Harshvardhan Roongta, CFP at Roongta Securities. Welcome to the show and thank you so much for joining us today. Now, before we actually begin the show, let's take a look at the winners and losers of today. Every day, as promised, we bring you the top funds in market cap and the thematic categories. While it is important to stay invested for a reasonable period of time to make money, it is also important to track fund performances. They are now flashing on your screens. Now to kickstart this conversation, let's first head across to our guest here, Mr. Roongta. And hello and welcome to the show, Harshvardhan. And the first question that I would want to ask, which is very pertinent to the kind of market environment that we are, the kind of backdrop that is at play currently. And the question here is, what would your suggestion be at large to our viewers? Is it the right time to be invested in a debt fund vis-a-vis an equity fund, given the kind of carnage the debt as an asset class has sort of shown up and has exhibited of late?
So Abhishek, if you're looking at an investor's portfolio, so we've always advocated that you need to have reasonable amount of equity and debt both in your portfolio. So that's asset allocation that we're talking about. So at any stage in life, irrespective of market conditions, irrespective of what is happening, the carnage that we spoke about in the debt segment, we need to have equity and debt.
Absolutely.
Now let's focus on debt for that matter. So your question is very pertinent and clearly towards the carnage in the debt mutual funds. Now when we talk about investing in debt, now within the debt category you will have fixed deposits, you have bonds, you have PPFs, you have all those kind of investments other than the debt mutual funds as well. So let's not deviate from the fact that we need to have investments in debt. Now, how much would you take exposure into, say, a credit risk fund offered by a debt mutual fund, or you would stick to fixed deposits, you would stick to provident funds, you would stick to which kind of an investment within the debt category? That is on individuals. So, now answering specifically, do you take exposure into debt mutual funds? So, well, there would be some exposure that you will need to take. You need to be careful of the investments that you're making in a particular scheme and what is the exposure that scheme has to which kind of paper. So if you're a risk averse investor, you don't really want to make money out of debt investments. You don't want to beat inflation. I mean, your only objective should be to meet or beat inflation.
Correct.
It should not be like a 14-15% kind of an expectation.
Right.
If you have that kind of expectation, equity is the asset class. So you fix yourself within that framework and then pick a scheme which has either a AAA rated paper or a slightly lower paper.
But debt needs to be an integral part of your portfolio overall. So that of course is the kind of view that we are getting from Mr. Roongta here. But let's get our first viewer here. Debashish is on the line from Kolkata. And Debashish, thank you for calling in here on the show. What is your query? If you can go ahead and share that with us.
Hello sir, my name is Devashish, age 43 years. I am from Kolkata. I have started investing from 5 mutual funds named L&T Mid Cap, ICICI Prudential Blue Chip Fund and UTI Equity Fund, which is 5,000 per month, and another one SBI Blue Chip Fund is 20,000 per month, and Mirac Asset Emerging Blue Chip Fund is 25,000 per month. So please suggest me whether they are good for future, as I wish to continue for another 15 years, or should I need to change the above portfolio plan?
All right, Harshvardhan, so the question that you're getting here from our viewer Debashish, he's listed down some funds, the likes of Mirae Asset Emerging Blue Chip Fund, SPI Blue Chip Fund, L&T Mid Cap, UTI Equity and ICICI Prudential Blue Chip. So he's investing into these funds via a systematic investment plan. So his question is, if you could review his allocation, and are there any changes that you would recommend to his current portfolio?
So the first thing, Debashish, is that it's nice to see that you've actually picked up one scheme of each category. So you have a mid cap, you have a large and mid cap, you have multi cap. So I think it's a good thing that you're doing. And I also understand and believe that your investments are largely a large cap oriented portfolio, so which is a good thing to do. Now, only one change I'll recommend in your SIP portfolio. Instead of the UTI equity fund, which is a multi cap fund, add another multi cap fund, which is a Kotak standard multi cap. Other than this, I don't think there's any need for you to make any other changes. The ICICI Blue Chip Fund, the L&T Mid Cap, SBI Blue Chip, Mirai Emerging Blue Chip, all these are good funds and you can continue to be invested in them with the same amount that you're doing right now. Just one change as I suggested, instead of UTI Equity Fund, change to Kotak Standard Multi-Cap.
All right, so just one change that Harshvardhan is recommending to you, Devashish. Any other follow-up question that you would want to be addressed here with Harshvardhan?
Yes, sir. So now I want to invest lump sum of 6 lakhs in a large cap fund, which will be continued for another 10 years. So one-time investment. Can you please suggest good some mutual fund where I can invest 6 lakhs of at a time?
6 lakh in a good mutual fund. What would your recommendation be?
So again, a good pick to take a large cap fund because they are the largest companies, and given the volatility that we are seeing, large caps are a good bet for long term. Now, you yourself, Devashish, have picked up HDFC Top 100 and Reliance Large Cap. So what I recommend, split the 6 lakh rupees into 2 parts. Invest 3 lakhs into the HDFC Top 100 that you've selected. The other 3 lakhs, I would recommend that you include an index fund in your portfolio, which is again a large cap fund but passively managed. So an IDFC Nifty fund would be a good choice to pick within the index fund category. So your investments would be between HDFC Top 100 and IDFC Nifty fund.
So HDFC Top 100 and IDFC Nifty Fund. Now let's move on to another query that we've received, in fact, through email from one of our viewers, Deepak Sachdeva from Bhopal, who in fact writes to us that I want a comparison between the DSP small cap, HDFC small cap and the SBI small cap funds. What do you recommend? So Harshvardhan, an interesting question. We are now at the start of the show, we did discuss the various aspects of diversification that one needs to look at. The previous query was to do with the large caps largely, and here we have a viewer who wants a comparison of some small cap funds as listed for us.
Yeah, so what we're looking at in a small cap fund, let's understand that clearly. So small caps are all those companies which have a market capitalization up to about 10,000 crores. Right. So that's the ambit in which you will invest. Now the question is, when you're picking up small caps, they're very volatile in that sense that because there is if large investments come in, the spreads tend to the prices tend to go up and all very quickly, because there is less of volumes in each stock. So what do you have to do when you're constructing a portfolio? If you have a larger base, so if you have invested in about 70 to 80 companies, then the risk gets diversified across different companies. So some may close down, some may do extremely well. So this balance is well taken care of in a small cap fund when they have larger number of securities in their portfolio. So keeping in mind the diversification aspect and the consistency of performance, I will rank these 3 options that he's taken in order. So my first choice would be HDFC small cap. The second would be SBI small cap, and the third would be DSB small cap. So in that preference, you can pick and invest and choose which scheme that you wish to invest into.
All right. So moving on from Deepak's query, we now have Chanava Saraj. He's online from Gulbarga, Karnataka. What is your query? If you could just share with us, and then we'll have that addressed by a guest here.
Yes, sir. Good afternoon, sir.
Good afternoon.
Yes, sir. I am 30 years old now. So I have invested in some mutual funds like the IDBI equity mutual fund, equity dividend mutual fund. So now my plan for my future is like I will invest 1 lakh every year in mutual funds, in different mutual funds for 15 years. I mean, now I am 30-year-old. Till 45 years, I will invest every year 1 lakh. So later on, I will withdraw after my 46th year, I mean, 46th age. So is that a good plan?
All right, Harshvardhan, if you could address that query from our viewer. In fact, he wants another review of his current investment strategy, which is in place. What would be your right guidance?
So the approach is very clear. Wants to invest for 15 years at age 45. Then after that he wants to start withdrawing so that he can take care of his expenses.
That's right.
So my only concern is that if you're investing 1 lakh every year for 15 years, you're likely to accumulate about 40 to 45 lakhs. Absolutely. If you're looking at a 14% rate of return.
Yes.
And if you want to withdraw every year after that.
All right, we'll cut you there. In fact, we now need to cut into Amitabh Chaudhary, MD and CEO Axis Bank, who is speaking to BTVI.
Yes, the banks have got together and signed in many cases because there is a clear agreement that integrated credit agreement is required. In some cases, some banks have had and obviously raised some objections, but I think generally the banks are all aligned in terms of what are we trying to achieve here. So yes, if there is a dissent, it is related to some specific issues, and banks are sitting down and trying to resolve them.
Do you see power sector also get benefit from signing of the ICA now, because that was the main contention?
Well, end of the day, signing IC only solves part of the problem. End of the day, you have to find either liquidate the asset or find a buyer or restructure the asset, because in many cases, in the current form, some of those projects are not viable. So signing an IC doesn't necessarily solve the problem. At some stage, in the next 60 days, in the next 180 days, you have to find a solution also. And that solution is going to come through a new partner coming in infusing equity, or the current promoter infusing equity, or you actually liquidating the whole project. So it's a case by case basis. The power sector resolutions have taken time because in many cases the current promoters do not have the equity and the buyers are few and far between. So let's see how it pans out.
So with capital raising, I think the question has been asked large and large. You have it in the next agenda of your board meeting. The main reason and the route, because those are the two questions.
We are just taking an enabling resolution. We as a bank have to look at our business for the next 3 to 5 years and prepare ourselves and be ready if the right opportunity arises. So as part of that whole exercise, we are just taking an enabling resolution from the board in the next board meeting. When the capital raising will happen, what form, shape and all is still far away.
Increased number of companies being declared fraud by the banks right now. Do you think credit increase in the market, corporate credit lending, is it going to be impacted in a lot of crisis situation? We have come out of it, budgetary support has come in. How do you look at the entire situation for credit increase?
I mean, ultimately we are in the business of lending money. And we are in the business of taking risks, so we are not shying away from taking risks. But I think what you're referring to when a lot of people are being declared as willful defaulters, it's a different thing in the sense that in all those cases forensic audits have been done and there is a clear case of diversion of money, and as per RBI circulars and directions, these people have to be declared as willful defaulters. Now that's got nothing to do with the fact that we do want to lend to the right promoters and entrepreneurs in India, and we are in the business of taking risk. Two separate things.
Are you interested in lending or having direct exposure in NBFC any further? Buying pools is one thing, but when it comes to direct exposure, how much headroom does Axis Bank have?
I can't go into those details, but yes, we have a certain risk appetite statement internally for Axis Bank, which every bank has, and we obviously analyze that and evaluate it at all points in time. And we have reasonable amount of exposure to NBFCs, but we also have to be very watchful and careful given the stress that is built up in that sector.
Are you having anything on table for pool buying right now? Is there any
that's an ongoing process. So
last question, there were conjectures about this RBI and Axis having some kind of understanding outside with the Kotak Bank having understanding in terms of dilution of promoter stake there.
As you rightly said, it's pure conjecture. So
All right, so you were listening into Amitabh Chaudhary of Axis Bank, and of course he did speak about the mega $1.3 billion fundraise that the bank is undertaking. He also did share his views on the resolution, where the SR resolution which the bank is now going to take to the Supreme Court, and most importantly on the NBFC issue, he said that the bank will continue to buy NBFC loan pools wherever the opportunities arise. Now getting back to our viewer query on the MF guide, which we were discussing with our guest here, Harshvardhan, wherein he did, our viewer did ask a query wherein he wanted the right guidance again to review his investment strategy. His age is 30 years, wants to invest 1 lakh in different MFs annually for 15 years. So let's resume that conversation that we were having.
Yeah, so Abhishek, as I was saying that, he's looking to invest for 15 years and thereafter remove money. So if in case he's depending on that money for his entire day-to-day living purposes, that will be grossly short, because you cannot really live with just 45 lakhs worth of a portfolio for the rest of your life. So nevertheless, having said that, the strategy otherwise is fine. Besides, if you leave the quantum out of the equation. Now another thing that I'd like to highlight is that you don't really need to invest 1 lakh every year in different schemes. So what you could do is just identify 2 schemes in which you could divide 50,000 rupees per annum and every year just top it up into the same scheme, because then you land up otherwise having 15 schemes, which doesn't really make sense. So what I can draw that outer line for you is that you can select two schemes. One is a large cap fund and one is a multi cap fund, and invest 50,000 in each of these funds every year. So you will still have two funds, but you're doing an annual SIP in that sense. So you can choose amongst the large cap category, you can pick the ICICI Blue Chip fund, and amongst the multi cap you can take the Kotak Standard Multi Cap fund. So every year just keep topping up into these two schemes, review the funds of course, and if nothing goes wrong with them, you just continue investing in them.
All right, Charnava, does that answer your query? In fact, the suggestion coming in to spread it out between two schemes, one large cap and one small cap. So I hope your query is sort of resolved here on the MF Guide.
Yeah, thank you very much.
Thank you for calling in. Now, in fact, we refer to another query that we have coming in from Raghav Seth from Kanpur. He has emailed to us. He says he wants to invest via lump sum rupees 15 lakh in mutual funds for at least 5 years, and my risk appetite is moderately high. Please recommend some best performers.
So, well, Abhishek, I'll just like to educate the investors on this risk appetite, time horizon.
Correct.
Because these are the parameters we always suggest that you should keep in mind before deciding which scheme that you take.
Absolutely.
So, one is of course your risk appetite, one is a time horizon, and the third most important thing is what is the purpose you're saving for. So, that is the goal that we're talking about.
Yeah.
Now, we have to look at all three together. Now, let's assume a person has got a moderately high risk appetite, which is this gentleman that we're talking about. He has 5 years time. We know these two things. We don't know why he needs the money after 5 years. So in case he needed this money to fund his children's education, then despite having a high, moderately high risk appetite, you might want to be conservative in your investment. Why? Because if you need money after 5 years, you need it after 5 years. You have to pay the fees of your college, children's college fees, and that cannot be deferred. Saying that market conditions are volatile, I do have the appetite, but the fees will be paid after 2 years. No, that cannot happen.
There are a few fundamental questions that you need to ask upfront to yourself before.
So all three need to be looked at in conjunction and then decided. So in this case, nevertheless, since it's a 5-year time horizon with a moderately high risk appetite, I recommend hybrid funds which have equity and debt both put together. And equity component would be of course 65 to 70%. So it also gets a taxation on the equity scheme basis. So what I recommend, Raghav, for you is, of course you want to invest 15 lakhs. So I would say 5 lakhs per scheme, divided into 3 schemes again, so that you get the fund expertise of the different fund houses. So 5 lakhs each in the following 3 schemes. The first one is the Mirai Asset Equity Hybrid Fund. The other is the ICICI Pru Equity and Debt Fund. And the third is a Canara Robeco Equity Hybrid Fund. So you will invest 5 lakhs into these 3 schemes. Review the funds, of course. You need to see whether these are performing in line with the benchmark and the peers. And this you would need to do probably once every year. So just after 1 year, have a look. Now, review does not mean that you have to chase the scheme which is giving the highest return in that particular year. What you need to do is just make sure that they are doing well. Need not be the best and the highest performing scheme. So don't keep switching in the name of review. Just see whether everything is going as per what you want. If it is, then continue. Else, if it's grossly underperforming its benchmark and peers, then of course you will need to move across to different schemes.
All right, hybrid funds is the recommendation for Raghav. Now on to our next query. Vijay Shankar is on the line from Bengaluru. What is your query? Please go ahead and ask them here on the show.
Yeah, hello, yeah. Good afternoon, sir. So I have invested in Franklin India Blue Chip for a couple of years, starting from 2014 to 2016. And I invested around 3.15 lakhs. And now it has become like around 4.2 lakhs. So based on my review or history, I feel like Franklin India Blue Chip is not giving great returns recently. So I'm planning to move that money without exit load, because it's already been more 1 year, to Kotak Standard Multi-Cap Fund. So I just want to know, is it a right thing to do or not? And again, this whatever the plan I'm saying, it's not something I need immediately. So I'm okay to wait for longer term, maybe even 7-8 years. There is no immediate need of the money. So I just want to know, is it making sense in this moment?
All right. So do you advise switching to a Kotak Standard Multi-Cap Fund for Vijay?
Vijay, when you're looking at a Franklin India Blue Chip Fund and a Kotak Standard Multi-Cap, as the name suggests, Franklin India Blue Chip is a large cap fund and Kotak Standard Multi-Cap is a multi-cap fund. Now, both are very good schemes within their own categories. So, in case you wish to be invested only in large caps, then you cannot shift to Kotak Standard Multicap, because the multi-cap fund will also have mid and small caps. So, strictly speaking, first identify which kind of companies that you want to invest into. Only the large and the blue chip companies of the country. Then you need to stick to large cap funds. So, either you could be in the Franklin India blue chip fund that you have, because it's a good fund within its category, or you can also switch to an ICICI blue chip fund, which you've also recommended earlier in the show. In case you are not convinced with investing only in large caps and you want a multi-cap, then of course then you will look at it in another perspective. If you're moving to the multi-cap category, then of course Kotak Standard Multi-Cap is one of the schemes, or you can choose the SBI Magnum Multi-Cap. The idea what I'm trying to advocate is very simple. If you're looking at large cap, pick a scheme within large cap. If you want a multi-cap, then pick a scheme within multi-cap. Do not compare the performance of a multi-cap with a large cap. It's like comparing apples with oranges. So you will not really get the right picture. So make a decision which category of funds you want, and then I've already recommended 2 names within each category, and then you make a decision whether you want to stick to the Franklin or the ICICI blue chip, or within multi-cap the Kotak Standard Multi-Cap or the SBI Magnum Multi-Cap.
All right. Any follow-up question that you might have for Harshvardhan here, Vijay? You might go ahead and ask them.
Yeah, sure. So actually, I've been investing in Reliance large cap because it's a large cap fund which I'm doing per month 10,000. So that's the reason I don't want to have a duplicate, and so that I thought instead of putting again large cap, I should look for some multi-cap funds. So that's the reason I'm switching. But anyway, I mean, I just want to know, like, Reliance large cap, how is the review overall? Is it good to continue that?
Is it good to continue
the
large cap?
Yeah, so ideally large caps would mean that you're investing into companies which have a market capitalization above 30,000 crores, and they're the top 100 companies of the country. So obviously, I mean, you'd want to invest into those companies because you're eventually being co-owners of those large companies. Now, also to understand that if mid and small caps also do have that little bit of alpha that you can generate, which means something which was a large cap today was a small or a mid cap at one point in time. So then you would want to have some bit of exposure in it. So multi-caps serve that purpose for you, wherein they will also have large caps, mid caps and multi-caps. Having said this, if you're asking me, if you have your investments in large cap currently, you can most certainly continue. Any addition that you want to make, so in case your income goes up and you want to start investing more than 10,000 a month, then of course you can move into the multi-cap category. So you'll have a blend of both. So I think that's the approach you would want to take at this juncture.
Thanks a lot. Yeah.
All right, Vijay. Thank you so much for calling in, and hope your queries are addressed here on the show. Now, we started the conversation, Harshvardhan, with your view on how important is to have debt as part of your portfolio, especially in the backdrop of the carnage, the so-called carnage that we talked about. And now, shifting focus to the equity to sort of close the conversation. Talking of equities, where do you see more potential when you compare the large cap vis-a-vis the small cap, and also the kind of risk scenario that is at play which you are sort of witnessing right now?
So Abhishek, as we've already discussed, what is a large cap, mid cap, small cap, we've understood that.
Correct.
So let's understand from an investor's point of view. So when I'm buying equities, I'm eventually buying shares of that company directly or indirectly.
Yeah.
So when I go through mutual funds, the fund house does it for me, but eventually I'm owning shares of a particular company.
Okay.
So which companies would I want to own shares of? So I would want to be, primarily, if I have 100 rupees to invest, I will want major component of that money to go into large caps, because they are well established companies.
Absolutely.
So about 50 to 60% you would always allocate towards large caps. Now, as I said, what is a large cap? The company which is a large cap today was once a mid or a small cap.
Absolutely. Yeah.
So the growth prospects are much higher in a mid cap than what it is to a large cap. So I would have about 20 to 30% invested into mid caps, because I would want that extra return.
But won't this proportion change with the kind of flight path an investor wants to take, given the risk appetite that a person has and the return potential that one expects?
Absolutely. So the idea is that we're looking at allocating out of that equity allocation. So if you had a total of 100 rupees to invest and you've decided to put only 70 rupees in equity and 30 in debt,
correct,
then this is a division of that 70 rupees.
Absolutely. Yes.
So I'm saying within that you will of course want to have major component into a large cap, and have some bit of exposure, which could be say 30% or it could be lesser depending on each individual. So that you have good mid caps in your portfolio as well.
All right.
A multi-cap serves this purpose because multi-cap is not mandated to invest only in mid-caps, only in large or small.
That's right.
So what you do is you cherry pick the companies amongst all different categories,
Yeah.
and you create a portfolio. So
Absolutely.
multi-caps helps in that category.
All right. Thank you, Harshvardhan, for joining us here on the show, and it's always a pleasure having a conversation with you. Well, with that, that's all the time we have on this edition of the MF Guide. More news and updates will continue on the other side. Keep watching Business Television India.
Thank you.